Ashley Foster, welcome to Love Your Money.
All right, thank you. I'm really excited to be here to share all this information with you.
I'm excited to hear about it too. I feel like we should introduce the side star, the other creature in your camera there, which is your kitty cat. What's the cat's name?
His name is Francois, Frank to his friends, and he is our 4-year-old Devon Rex that my wife got me as a Christmas present back in 2019, and he's been like our little buddy ever since.
And he's just like curled up in a ball there. He's just like
He's chilling.
unflappable.
Yeah, he's chilling out. He's getting ready. We're vacationing to Hawaii on the 22nd of May, and he's getting ready for his sixth trip to Hawaii.
Oh wow.
So like he's a little traveler. He does really well.
Okay, amazing. Well, thanks for having him on the show. He may be the first cat on my show. So
He's quite the star.
love it. Would you please tell my audience about your career journey that made you an expert on whole life insurance? We're here today to talk about whole life insurance. So tell us how you got to be where you are about that product.
Oh boy. In a galaxy long, long ago, galaxy far away.
Uh,
No, but back in 2007, I graduated from college, and I always knew that I wanted to be a financial advisor. But I was a college athlete and went the humanities kind of route, liberal arts route, and never really imagined myself like having the opportunity to do so. So I graduated from Florida Tech, came back to Houston, Texas, where I was from. The economy was really starting to bite back in the day, and so because of the Great Recession, and so I got into recruiting, and I hated it, and I hated working for other people. I had my own little side business in college to make a little bit of extra money, and I wanted to do something entrepreneurial. So lo and behold, my mom, God bless her, was out at a networking event and was handing out my resume to whoever, would take it. And it fell
your
into
mom.
my mom of all people. I'm half Mexican. My mom's the Mexican in the family. And, she is like a bulldog for me. And so she knew I wasn't happy. And she was like, hey, I'm going to go out and just see what I can do for my son. Right. Got into a partner at New York Life Insurance Company's hands. Partner is just a fancy word for sales manager. And so I got a phone call from her to come in for an interview. 4 meetings later, I've got a job and I'm a quote unquote financial advisor, life insurance agent. And I thought I hit the jackpot. I was like, oh man, this is great. Like, I loved CNBC back watching it, like all of the bright lights. I'm super ADD. I was like, I'm finally going to be like the next Jim Cramer. You know what I mean? Did not happen that way. Went into training. New York Life has got a wonderful training program. It was 2 weeks, but it was mainly focused on sales, and it wasn't really focused on product. It was, on sales and product, and it wasn't really focused on advising people. It was really focused on, putting a specific product in front of people and
Right.
really trying to push that. I didn't know any different. 23 years old, what I know, bright-eyed, bushy-tailed, right? Let's fast forward sometime to about 2011, 2012. And I made it through the Great Recession. It's a 100% commission job. It was really, really
You
rough,
hustled.
but man, I had to. Anyone that could fog a mirror was a prospect for me. And that's literally what they said. If you have someone that can fog a mirror, they are a prospect for you. So made it through all of that, became my own partner in the Houston office, was one of the youngest partners in the company at that time. And I was tasked with building my own sales team. And
Mhm.
it kind of got to the point where I remember early on in my career, I was like, I don't know if I can do this management thing. It just doesn't feel right bringing people on board to then go out and like sell their friends and family life insurance. And then the attrition rate was super high. I think like after 3 years, 90 something percent of the people that start like fall off.
Hmm.
Right. And I just didn't feel comfortable with that. So I didn't last long. I probably lasted maybe like 8 months. And then I had an opportunity to go work with a mentor of mine who was not in the biz with New York Life. He was an independent financial advisor. And one of the things that he told me was a prerequisite to come work with him was you got to get your certified financial planner. Now, granted, my old business partner was a super old school life insurance guy. There's a story of him selling life insurance at a funeral. Okay. Like this dude was like
I'm
super
shaking my
salesy.
head. Those of you listening on the podcast, I'm shaking my head. It's such an eye roll.
Right. And it's like it's just the wildest thing. He's a great guy, but man, any opportunity he got to push life insurance, I mean, he was in it. He was just old school sales dude. And but the best advice he gave me was to go ahead and become a certified financial planner. That was like his prerequisite. Taking those CFP courses, Hillary, really changed the direction of my career. All of a sudden, I was like, I'm not pushing product. Now I'm learning how to like taxes and like how to apply insurance in like a fundamental way to be able to help a client, right? Or investments or just general financial planning
Right.
type principles like saving money, right?
How to
Spending, all of
actually
these
help
things.
people in a consultative way.
100%, right? So it wasn't a sales process, right? It was a consultative process to help a client get from point A to point B to point C, right? And it just felt so different. I was like, man, this is what I really wanted to do.
Okay, so you've been there, done that, and in a way, rejected or walked away from that insurance company life. Interestingly, my dad worked for the New York Life when I was born.
Oh,
So I'm familiar. So let's start from the beginning. So folks listening may not even understand what whole life is. So what is a whole life insurance contract?
yeah, so that's a good question. So it's in the name, whole life. It's a life insurance contract designed to literally last you your entire life.
Mhm.
And when I started in the business in 2007, the age table went up to 100. Then it got revised to 120. So what happens, let's say, if you make it to 120, okay?
Mhm.
The policy then pays out all of the cash value that it accumulates. So think of whole life as the way that they trained us to think about it is that it is a forced savings vehicle with a life insurance component attached to it. You pay your premium, it builds up a quote unquote cash value. And then from there, at a later date, you can use this cash value. And they would always tell us tax free. There's a little bit more intricacy into this, but
Yeah.
you can use this cash value to go ahead and pay for anything that you want, basically, right? And use it as a loan from the policy. So in the olden days, term insurance, which is the other insurance that your users may be familiar with, term is like temporary. It lasts for a specific number of years. If you pass away, it pays out a death benefit. If you don't pass away, the policy basically goes away because it becomes
Mhm.
too expensive after the term for most people to keep. Back in the day, there were not many savings vehicles available to people, right? Like you couldn't in the 1930s go and like, buy an ETF or anything like that. So whole life insurance was very much the
Correct.
primary way that most families would do their savings. And so they would
Oh,
pay
so
those
that's
premiums.
the way they would access stock market investments.
Almost like that. So remember, whole life is not invested in the stock market. It is invested in the what's called the general account of the life insurance company. So the life insurance company has a big account with billions and billions and billions of dollars where all of these premiums go in, right? And they have all of these kind of different investments, but they basically have a almost somewhat predictable rate of return on this general account. And that's how the whole life policy can provide a very conservative, okay, so think of like a high yield savings account kind of rate of return on the policy without any volatility. So there is a guaranteed component of the whole life, and
Mhm.
then there is a non-guaranteed component of the whole life. The guaranteed component of the whole life is you pay your premium, there will always be this amount of cash value, you will always have this amount of death benefit. The non-guaranteed component, the insurance company says that they are going to pay you a dividend, okay, on top of what your cash value earns. Essentially, a dividend is a fancy way of saying that the life insurance company is returning an excess of premium. At the end of the year, they calculate, okay, these are my expenses, overhead, these are my profits. I paid out also these amount of claims. So then I'm going to return a portion to our policyholders. That is, if it is now it gets confusing, if it is a mutual / privately owned company. public companies offer whole life insurance, right? So like Lincoln Financial Group is a public company, but they no longer offer whole life insurance policies because it's not very profitable for them in the near term. So private companies can typically, like New York Life, can offer a whole life insurance policy because it's not very profitable for them early on, but it is in the longer run for them. So they keep you there by giving you quote unquote dividends, which enhance the returns of your quote unquote cash value. So the next question you may have is like, whoa, what returns can I expect? Typically, you can expect almost bond-like returns. So in the long run, I have a whole life policy that I still have that I
You
sold
do?
myself. I do from 2011. I sold it to myself because I earned a commission on it. So so why not? But I never canceled the policy. So I still have it. It's like $150 a month. You know what I mean? And I don't know, for some reason, it's like my attachment to the life insurance. It has a little bit of a special meaning for me. Because my wife is like, well, why don't you cancel? It's like, well, I don't know. If I die tomorrow, you get a little bit of extra money. Like, that's not a bad thing, right? But it is almost like bond-like returns or high yield savings account returns. So in the long run, this policy should generate me over a 30 to 40 year period, somewhere in the range of like 3 to 4%.
Okay.
So this isn't something that's like, you're going to make a lot. You're not getting rich off of it. Although on the flip side, a lot of agents will sell it as like, you're going to get rich off of this thing. And that's where I saw the conflicts of interest.
Well,
And
that's why
that's what
consumers who buy them get disappointed.
100%. So most life insurance policies don't make it to the 10th year. And a lot of those whole life policies. And a lot of whole life policies need at least anywhere between 6 to 7 years to go ahead and break even. So if I could go ahead and give you an example, it's like having a home, right? If you think about it, right? A home builds equity. Same with the whole life insurance policy. It builds equity, right? It's not invested in the stock market. It's a piece of property, right? Kind of same with the whole life insurance. And generally, if it's not like a crazy period, you're going to get like a 3 or 4% return, like typically in the past you would on your home. Now kind of being a little bit different, but still over a period of time, there's a break even point, right, on your home where, you know, what you put into it with all the mortgage and stuff like that, right? Now you're kind of breaking even on what you've put into it versus interest and your closing costs, stuff like that. The life insurance policy almost acts the same way because in your first 7 years, your cash value is like minuscule. So it's taken me on my policy close to about 8 years to where the money that I put in now equals the cash value. So now I'm making a positive return. So I've gone back and actually did the math. And like, if I would have put that
Wait,
money
I have a
instead,
question.
sure.
Can you tell me the math afterward? But so you're paying $150 a month. What is the death benefit for that amount of money?
$100,000 for
Okay,
a,
so it is small. It is a small policy.
correct, for a 28-year-old with a good health rating.
Right. Okay. And then you did the math. Go ahead.
Yeah, so I did the math and I said, well, you know, like if I would have put like $150 a month instead into the S&P 500, right? What would I have? I would have had probably almost 3 times the amount of money, right, in the side
Thank you.
S&P 500 fund than I would have had in the whole life insurance policy, right?
And that's
So
clear. That gives people ways to weigh the trade-offs. I appreciate that math. Um, so is it possible for you, do you know, or is it even clear and consistent how much more expensive a whole life policy would be in terms of premium than a term life policy for the same death benefit?
yeah, so I mean, probably anywhere between like 6 to 10 times more expensive, right?
Six to
So
10 times.
if I could probably get back then a 20-year term insurance policy at 100,000 as a healthy super preferred. So when I say preferred, super preferred, non-smoker, those are the health
Right.
ratings, because they have to assess your health risk to give you the policy. So the healthier you are, the less expensive it is, the more discount you give on the premium. And so for like $150, I probably could have gotten somewhere in the range of like like probably like 1 million to 1.5 million of 20-year term life insurance for my
Okay.
age at that time. So it is a significant difference in the type of death benefit you can go ahead and get versus for a term life insurance policy versus a permanent life insurance policy, like a whole life policy.
Right. And so is it possible for someone, let's say someone between the age of 35 and 45 buys a $500,000 whole life policy, how
Hmm.
much would the sales agent make?
Yeah, so that's so if I was at, depending on the company, but I'll typically about on a whole life policy, about 50% of the commission in the first year. So they make 50% of the first year premium, and then
Okay.
typically after that, they receive a trail of renewals to keep the policy in force.
Um,
So let's say
right.
that
So
you
the
put in
agent continues to
10,000.
get paid.
Correct. So let's say you put in $10,000 a year as a premium, okay? You would get $5,000 as a first year commission. And then after that, you would probably maybe get somewhere in the range of like anywhere between 1 to 3% of the premium after that as your renewal. The
Okay.
idea
So it's
was
significantly higher in the first year.
correct. Yeah, correct. And that's obviously the incentive. Now, if you some companies, and this is getting a little bit in the weeds, but some companies will go ahead and charge you back if someone that bought a life insurance policy from you surrendered it in the first year, or sometimes maybe surrendered it in the first 5 years. But generally, the incentive was, if you're selling a term life insurance policy, you're getting maybe 50% or maybe 60% of $1,000, or you're getting 50% of $10,000, right? Like, kind of what's the incentive for you if you're the sales agent out there, right?
Right.
Like,
No, I know.
especially, right,
I always
especially if the
feel
training
bad to
is geared
telling my
towards it.
insurance the people I refer insurance, um, uh, uh, I guess quotes to. I always feel bad because I know they're not making much on commission because I only let them sell my people term policies.
Yeah, same with me. Yeah, same with me. And my old business partner, he and I have an agreement. I said, and I basically said that, like, hey, like, any client that I send your way, like, they're in a bubble. You don't talk to them about any other type of insurance or anything like that. If they need, there is a need for permanent insurance out there. It's a very specific, very niche type of need. Generally has to do if someone is like ultra conservative, or if they maybe have an estate planning issue, or they want to leave, or they just want a lifetime life insurance benefit. Mom and dad had permanent life insurance. I want permanent life insurance too, right?
Right.
There
I've had
are,
someone describe it to me as a guaranteed inheritance for your heirs.
it could be, right? Depending on how you want to go ahead and handle it and structure it, right? So there's
Right.
niche reasons, but I let him know, I say, because all my clients are, 26 to 45 years old. Like, this is the type of policy and don't sell them anything else. And
Right.
and we have a great relationship because he doesn't do that. And that's
Right.
excellent. And for a life insurance, I mean, for a financial planner, it's very difficult to find an insurance agent who will basically, stay in that lane and then
Yeah.
also not try to upsell your clients. And we have a good relationship, and I send them a good amount of business.
So were you instructed by the New York Life? Are you required? Okay, let me start that over. Are sales agents required to be transparent about the commission that they earn if people ask, or was that even an option for you if not required?
Yeah, so it wasn't like they said, like, hey, you should lay out how much you get up front, right? Generally, one of the ways that one of the partners told me how to handle this question is that, like, like, I'm not paid by a commission by you, the client. I'm paid by the companies that I represent. That was kind
Mhm.
of the way that we handled that question, right? And I never really had anyone like, I've been doing that, the life insurance game now, back then for, almost, 10 years. And I never had anyone ever ask me, like, how much are you going to make from this? I did
Hmm.
have people say, like, how do you get paid? I get paid, right, by not by you, the client, but by the company I represent. They pay me a commission of the policy that I sell. And that typically was it. And that really was the way to kind of like deflect the question.
Yeah, except all costs come down to the end consumer in all cases, because
Mhm.
right? Um,
Exactly.
okay, and did they instruct you to call yourself a financial planner?
So back then, New York Life, one of the things that they were really good at was telling us to make the distinction that we were not to market ourselves as quote unquote financial advisors, because you needed licenses in order to go ahead and say that you're an advisor, right? So you needed an insurance license to sell insurance. Then you needed what's called a Series 6 and 63 to go ahead and sell mutual funds, open individual retirement accounts, things like that. And then you need a Series 7 and 65, I believe, to go ahead and actually do financial advising through them. So they were very, one thing about them was is that they were very compliance conscious. And so if we had a Series 6 and 63 where we could sell mutual funds or another type of permanent life insurance, which is called variable life insurance, universal life
Mhm.
insurance, or a variable annuity, variable meaning that it's invested in the stock market, we were to call ourselves financial services professionals. Okay.
Okay.
Other folks I saw in the business, all right, that did not work for that specific company, basically could just call themselves whatever the hell they wanted.
Right.
Right. So at least I give New York Life props for like kind of like trying to be as ethical as possible, right? But at the end of the day, they're also kind of like covering their butts so that like, I didn't go out there and say, I'm a financial advisor. And then, I said, hey, do this. And then all of a sudden it can come back on me, right? And then it obviously goes back to New York Life. So they were kind of
Right.
very regimented to like cover their ass, right? So like that's why they had, those types of descriptions. But anybody else, it was almost like the Wild Wild West. I mean, I knew guys and gals that were just straight life insurance agents. They represented multiple different companies. They were
Mhm.
independent. They said, I'm a financial advisor. I'm here to help,
Right.
and obviously that wasn't the case.
And so I want to give people a sense of, I mean, I guess it's interesting because what you're doing for the company and you're not on a base salary, you're commission only. And so you're
100%.
selling these policies and you're
Yeah.
winning these prizes, these like expensive trips and things. What were some of the prizes? And I guess you were really good because, you're winning awards. And so what are some of the things that you were winning?
Yeah. So first off, you won the opportunity to continue working there. So so
Number one
that
prize.
that was the number one prize. You got to keep your contract. So there was obviously, so the challenge with, and because I think this goes into a greater, kind of dissects the question a little bit more and gives the listeners more insight. The challenge is that our contracts, including retirement, health insurance benefits, all of these things were tied to selling whole life insurance, right? The more whole life you sold, frankly, the more insurance you sold, but frankly, you got paid more on whole life, right? And so you had minimums that you had to go ahead and keep. And so if I wanted to keep my health insurance, I had to sell a minimum number of commission, right? And then above that, they had what was called sales clubs. Excuse me. So they had sales clubs. And so if you hit one sales club, you got a recognition, you got a little plaque, something like that. The higher you went, the more extravagant the trips were, the more extravagant the rewards were. So when I hit my stride and was having a lot of success in
Mhm,
the life insurance, I mean, like I said, all expenses paid trip to Prague,
mhm.
stayed at the Four Seasons, got to hobnob with literally like the chairman of the board of a Fortune 100, right, 500 public company and other board members. I mean, it was incredible how we were treated. We were treated like celebrities and rock stars. Like I'd never experienced anything like that in my life. Um, my wife kind of goes like, man, well, too bad we can't go on those trips anymore. You know what I mean? I was like, I know I'm kind of in
Yeah.
the business. We pay for our own trips now.
Yeah.
Right. But even on this, on the lower level clubs that you would hit. So one of the years I didn't hit the top level. I came into at the second level. We went to a trip. We stayed at a really amazing resort in San Diego. I think it was the Coronado. I think they had like one of the guys, the DJ from like the Beastie Boys come in and do a pool party for us. Everything was paid for. I mean, it was legit. It was an awesome opportunity.
You
But
were going, I
obviously,
have arrived.
right? But obviously, if you go back and dissect all of this, these are huge, massive conflicts of interest, right?
Right.
Like I serve my clients today because number one, right, I enjoy the work that I do and I enjoy helping people. Number two, it's I make a living from it, right? On the flip side, though, in the life insurance world, and frankly, some of the bigger companies and things like that that also are what are called broker dealers, they'll incentivize their folks by, trips and things like that. I mean, it's really hard to separate those conflicts of interest, right?
Right.
So, if you're a salesperson, you want to go on the fancy trips. Go to two of them. Your significant other expects to go on the third, right? So like it's just kind of this whole gamification thing. And, the incentives were just kind of perversely structured that like sometimes you didn't really focus on, is this right for the client? You were just focused on selling the policy, right? And that was kind of like the whole thing that got me really thinking like, am I doing the best thing for my client or not, right? And taking the CFP course really solidified that like I don't think I'm doing the right thing for my client, right? I
Right.
think I need to be doing it another way. And that's why I started my firm, NextGen Financial Planning, after leaving the big company in 2018.
Right. That's a big change to go from New York Life to being the owner of a firm where you have to build the business or you don't get paid at all. And you don't have the brand name or the marketing power of that big company behind you anymore. I want to circle back. Oh, so, if you're listening, what I want you to take from what Ashley just said is if you're considering purchasing a whole life contract, your premiums are paying for those trips, right? Like
100%.
you're paying for people you
100%.
don't even know to get DJ'd to by the Beastie Boys, right? To just
I
be
never knew who
there.
that guy was. I knew who the Beastie Boys was. I was like, oh man, that guy's having a great time. Yeah, he probably got paid a good amount of money to be
Oh
there.
my goodness, the Beastie Boys. I had their A Licensed Ill album on cassette, listened to it on repeat when I think it was freshman year of high school or something. Anyway, I want to circle back so as to not be perceived as completely biased, because that's how I'm positioning this conversation is you're the unbiased one. And I think it's clear what your conclusion is about whole life as a planning tool, but you had mentioned there are use cases for whole life. You are
Correct.
one of them. You have your
Yes.
policy. You just want to keep it. You understand the upsides, downsides, the costs. It's fine. It's your savings account with a death benefit attached to it.
Mhm.
And the second being, we mentioned a guaranteed inheritance for your kids, assuming you can afford to do that and achieve all your other financial goals. And then you sort of mentioned the estate planning needs, and you and I know what that is, but I want you to please explain it to my listeners because they probably don't know what that refers to. So can you give the use case for for a couple who needs the whole life policy to pay for estate liquidity?
Yeah, so that's so take somebody, I think the limits are now, I think it's like $11 million per person if you're married. So if my wife and I were worth, let's say $23 million, that's an exclusion from what are called estate taxes,
Mhm.
right? So
So
the
you can
government
die
will,
with an estate that's worth up to almost 23 million and not pay any estate tax. And the estate tax is expensive. It's 45%.
it is. And so the life insurance policy comes in as discounted dollars to pay for that estate tax. So so let's say you're worth $30 million, you're gonna pay, your estate or your heirs have to pay 45% on 7 million. They got to come up with that money like really quick. You either like, quote unquote, sell the family farm to go ahead and pay for that,
Right.
or you can go ahead and use this life insurance policy that pays when you die. And these dollars will go ahead and cover the estate tax, right? Thus preserving the assets inside of the estate, right? Because most people, when majority, almost all people, when they're not sitting like Scrooge McDuck on a big pile of cash that they can then just write like a big check
Right.
to the government. They have assets. They have, maybe they have private stock that they can't liquidate, or they have, a company and machinery and land and all of these other things.
Or
So the life
22 rental
insurance does benefit
properties.
from that. Exact things that they can't liquidate, right, very quickly, or if they did, it would be like a fire sale, right?
Right.
And so, the life insurance basically, here's the cash, pay off the estate tax, and preserve the remainder of the estate for the individual, for the heirs, basically.
Perfect. Okay. So you and I agree. Those are the three most reasonable use cases for whole life policies. By the way, Francois is awake. He's having a little bath. Very cute. I love having the cat on. And you answered one of my questions. One of my questions was going to be, do you yourself have a whole life policy? So you answered that. And it's a small one. I mean, relative to what would be your net worth or your desired net worth at your date of retirement, it's not that much. So you're considering it a small piece of your overall financial plan. Have you recommended whole life at all to your clients?
No, not, and I'm really trying to think about this. I've unwinded more, dubious whole life insurance sales, to clients that have come to me than I have probably ever recommended. So I'm really thinking, I don't think that I've recommended to any of my clients that they purchase a whole life policy or any type, because there's other types of permanent insurance, or any
Yeah.
other type of permanent life insurance.
Okay. All right. Good to know. I think that's where the rubber meets the road. Really appreciate all of this amazing wisdom you've dropped today on Love Your Money. And I have one final question for you. Are you ready?
Yes.
If your money were writing you a love note, what would it be thanking you or complimenting you for?
Yeah, I love that question, because it really gets you to think introspectively. And there's a quick story behind my answer here. And the note is, thank you for not burning me. And
Oh,
so what I mean by that is that when I had those two really big years in the life insurance business, I made more money than I'd ever seen before in my life. I think I made more money than my parents have ever seen before. Right. And
congrats.
all of a sudden you get a $500,000 check that hits your bank account. And you're like, oh my God. So as a, at that time, I hadn't met my wife. I was probably maybe 6 months away from meeting my wife at that time. Um, there was a lot of thought process of like, let's go to Vegas. Let's go do some really stupid things with
Was
this.
that thought process or was that knee jerk?
It was almost a knee-jerk reaction. You have like a 31-year-old single
Yeah.
man who comes across the biggest
Dangerous.
day of his entire life, and he has stars in his eyes. And I didn't do that. What I did is that I made sure that I fully funded my 401k that year, because it was the first time that
Oh,
I could do that. And then also I set up a savings account. I paid off all of my student loans. I had to, at some points, I took loans from my parents because cash flow was tight some of those times. Especially when I was getting my CFP, I was making hardly any money at all. And so I paid my parents back because they loaned me some money to help keep me afloat during that time. I invested in the stock market. I opened an E-Trade account and bought my first stocks. Yeah, did I spend some of it pretty dumb? Yeah, I bought some fancy suits that I don't really wear anymore.
nobody does.
And stuff like, right, exactly, especially after the pandemic. But the story of that is that when my wife went to work for her recent company, we had an opportunity to invest money in her company at the time. And I had set money aside from that payday in a savings account. And that was the money that we used to invest in her company. And that has grown
What a
massively
blessing.
for us. And so looking back now as a 40-year-old married, mature man with a fur baby behind me, um, I I didn't burn my money by being stupid with it. I saved it. I did smart things with a majority of it, and that has then been able to multiply a lot of our wealth later on, and has given us opportunity to invest and really, if everything pans out with her current company, then things are going to be wonderful. So I'm sure that's what my money's thanking me for, if they could write me a love note. So there you go.
Love it. I bet your wife is grateful to you too.
We're all, she's amazing. She's been such a rock for this, especially in my business. She turned me around. A lot of the success I have, I've really owed it the partnership with her.
Oh, very cool. What's a place on the internet people can find out about the things that you do in case they're a veterinarian and want to meet you?
Yeah, or if they want to see our next gen mascot, Francois, he's also prominently displayed. So it is www.nxtgenfp as in financial planning.com, next gen financial planning.
Wow, you made that one kind of hard to verbally give to people, huh? All right, we'll have that in the show notes as well. Very much appreciate your time, Ashley. Thank you so much for being here.
Thank you, Ellie, for having me.